Hello traders, Gary Wagner here, approximately 12:45 in Honolulu, 6:45 in New York. It is Tuesday, September the 7th, 2021, and this is the daily report for gold and silver. We saw gold plummet to the tune of about $37 today, silver down harshly also. While I think that the disappointing jobs report on Friday pushed gold up, a little bit overdone, I certainly think we had an exaggerated downside move today because there wasn't really any fundamental change in market sentiment. There was a strong dollar, an uptick in bonds, but not enough to take gold down as substantially as it did. That tells me that there were short-term traders pulling profits and maybe something else, and we'll figure that out over the next couple of days. But we'll talk about that during the show, and that will begin now. Traders, a brutal day for gold and silver bulls, with gold losing over 2% and silver losing just about 1.68%. Gold, basis the most active December 2021 contract, lost $37.60. It is just below the 50-day moving average. We'll cover that when we pull up our charts, and is currently fixed at $1,796.10. While higher yields were partially responsible, so was dollar strength, with the dollar up almost 0.6%, 51 points or 0.517 points, and is currently fixed at 92.55. Gold experienced the single largest one-day drop since the last jobs report that resulted in a flash crash, and that, of course, was for the July numbers. This was for the August numbers. The August numbers came in bleak, and that's what took gold above both the 200 and 100-day moving average, taking it to a intraday high of 1836 in trading. And today it opened at 1833, but failed to have any follow-through, and we saw a brisk and pretty severe sell-off. Now, as far as I'm concerned, we are at a critical area on a technical basis, and that is the 50-day moving average. Gold is just slightly below that because we are currently trading at 1796.10, and the 50-day moving average is just above it by about $1. We'll see how it trades overseas as Australia, Asia, and London begin to trade. If it cannot hold this area, the logical point to look for would be some recent lows. The first one comes in at around $1,787. One below it is at about 85, with the major level of potential support coming in as the 38.2% Fibonacci retracement at 1776.30. Of course, we went long just about $1 below this price point, but I certainly felt much better about that on Friday as we went into an extended 3-day weekend. I think that the move that we saw on Friday might have been a little bit overdone, but I definitely believe today's sharp decline was absolutely overdone for it to sell off this harshly with no significant changes on a fundamental level. Whether or not the Fed begins to taper in November or December of this year or Q1 of next year is something we'll learn more about during the next FOMC meeting, which occurs about mid-month this month. However, based upon the disappointing jobs report and the uptick in COVID infections in the United States, we are leading the world in number of cases. I find it hard-pressed that the Federal Reserve will become more aggressive in terms of their tapering timeline, first. And second of all, because they are tapering doesn't mean that they've stopped allocating more capital, and we haven't even heard about how much they would taper on a monthly basis. And those are key and critical factors, because in the case of tapering, tapering is an inflationary force because the money that they're using to purchase assets goes into the money supply, providing liquidity, and that, of course, is an inflationary aspect. So tapering sooner rather than later would put some pressure on gold, but the devil is in the details, because if they're tapering 10 billion a month or 20 billion a month or 5 billion a month, those are key distinctions that would definitely frame market sentiment in regards to gold. For now, we will maintain our current long position, but we are going to watch it closely. I'm not so concerned about being stopped out. I believe our stop is further down. However, this decline today takes me out of the positively bullish area to bearishly concerned. There's no other way to put it. Traders, a key component today to the dramatic sell-off in gold was dollar strength. We're looking at a daily candlestick chart. You can absolutely see that it was a pretty large green candle that formed. Not only that, it opened above the 38.2% fib retracement and closed just shy of its 50-day moving average. I pegged current resistance at 92.55, the 50-day moving average, as well as 92.75, which is the 23.6% Fibonacci retracement. I also put support at the 38.2% fib retracement, which is 92.13. Silver also lost major ground today, giving up about 42 cents. That's a decline of 1.68%. Current fix on December silver is $24.38.5. Unquestionably, silver gave up some ground today also, but only about 1.6% when compared to gold's drawdown, about 2% on the day. We've talked about the fact that there is a disconnect that we have seen occur lately between gold and silver. However, on this day, the only disconnect was that in terms of a percentage drawdown, gold led the way. Typically, it would be silver. We are currently trading in Australia $24.38. In terms of major resistance, it is his 50-day moving average at $24.83. In terms of support, it is at $23.72. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.